It's Jonathan, your favorite founder from Unsensible. So you watched me critique these startup founders and you're thinking, who is this guy? And should I be listening to some random stranger on the internet tell me how I should pitch my startup? Why not? It's where you get your vaccination information from, right? Well, you're going to be delighted to see yours truly pitch how to pitch an investor to not one, but two investors. There's a bear trap for every bear, as they say, and the teacher becomes the student. Boy, oh boy, this is going to make you happy. The two investors are Leon Eisen, PhD. Not only is the guy an actual quantum physicist, but a serial entrepreneur and investment manager at Network VC in Silicon Valley. And Mike Grundy, who has built Amazon Papyrus Chemicals from the ground up to a $200 million exit and now sits on the board of PRD Angels, a Greater Bay Area focused angel group in Hong Kong. This was originally recorded for a Founder Institute event, and there's a great panel discussion afterwards in which both investors will drop some truths that as a founder you're going to want to hear.
This session tonight is going to focus more on the investors and pitching. And so it's really great to have both Leon and Mike here tonight because they represent different aspects of the investor market. Leon is involved with Network VC, which is a large venture capital fund in Palo Alto, California, and he's one of the investment managers in that. And that's a fund. Whereas Mike, as he mentioned, he's a member of the PRD Angels, which is a group of angel investors which are largely investing by themselves individually. So taking a little bit of a different approach, and they have a slightly different focus on the market. So that's why I think it's great to see these two perspectives. The first one, the venture capital fund, represented by Leon. Next slide. And then Mike, as I mentioned, is representing the angel investor, the individual investor, perhaps a little bit more early stage, perhaps slightly smaller amounts, but I'll let those two gentlemen talk about their investment criteria and approach and give you those details. I think what's important to emphasize is that there is a real focus by Mike and all his colleagues on Asia. I think they're industry agnostic, but I'll let him talk about that. So not only do they give you two perspectives on investing in early stage companies, they're also quite focused on Asia, or increasingly so. Next slide, Warren. And Jonathan has done, I haven't met anyone else who's done the amount of research that he has done on startups. And I'm not going to steal his thunder by quoting any stats. I'll let him do that when he gets to his presentation. But he's really got a unique presentation. It's a bit of a template for early stage companies to consider when they're approaching their first round of funding. So he's going to walk you through this idea about how you can be most successful in pitching. And then when he has completed his presentation, I'm going to open the floor to Jonathan, Leon, and Mike and have them debate whether they have some other ideas that they think might be useful for early stage companies to do in fundraising and presentations. And so hopefully by 8 o'clock Hong Kong time, you will have gotten a good perspective of what you should be thinking about as a founder approaching the fundraising for the first time. Next. So that is the panel discussion we'll have at the end. I'll just moderate it. It really be Jonathan, Leon, and Mike who are giving the value added. And of course, Warren will be here managing the master of ceremonies and keeping this all together, just like he did for the first 15 minutes. Mike, it's great that you're here. I'd like you to sort of talk about the approach the angels take, and maybe it differs between the different people, investment criteria, and any other hints or suggestions you might give to people who are approaching PRD about how they might be most successful. So I'll just turn it over for you for up to 10 minutes or whatever you like.
Okay, thanks, John. So I'll give a quick overview on who we are as PRD Angels. We started 6 or 7 years ago, and we've got about 35 members now. A big variety of members, sort of, I'd say a businessman like me. People have come more from being in the investing side for a long time. We've got doctors, we've got lawyers, so we've got a very wide range. I find it very useful because I tend to get a bit excited when I see these new startups and want to get straight in. But the question and answer sessions that the team has, I suddenly think, I didn't think about that. So I think the group that we have really give us pause for thought and really filter out any problems. As I said before, I'm on the board of directors for the group, and we have committees like the deal committee, governance, membership, and external relations, where we're trying to reach out to other people that may have relevance to us. We hold monthly meetings, and typically then we have about 4 companies that pitch to us, very structured, about 15 minutes of a pitch, and then 15 minutes of question and answer, which, if I'm honest, tends to go on a little bit longer than that. We then, if we like a pitch, a company, we either invest as a group of individuals. It's unusual for the whole group to invest because people have got different perspectives and timing and everything else. But there could be 6, 7, 8, 10 people get together and invest. And when we invest, it could either be individually in our names, or through, we set up a BVI or sort of offshore company, and we invest through that. We really are looking, of course, it's very common knowledge. We want to see what the business is like and what the opportunities and the future, but it's still, I believe, the number 1, 2, and 3 items are the people. Who is it in front of us? Do they give us confidence? Have they got experience? Or if they haven't got experience, have they got a team behind them of supporters and mentors? That's so important. Some of the failures we've had, and of course we've had failures, it's generally down to the people making mistakes. So that's absolutely key for us. As angel investors, we're not investing huge amounts. I'd say the average would be 100,000 US as a group. So as individuals, we might be down at 15 or 20,000. But with some companies, we've had successive rounds. I mean, I think one company we're well over 600,000-700,000 that we've invested in as a group. But as angel investors, generally it's much smaller in those early stages. So our deal committee is responsible for reaching out and trying to find potential companies, and they do that through their network and attending some events. But also, I think our name is getting out there in the marketplace, certainly in Hong Kong and the Greater Bay Area, and so more and more companies are knocking on our door. And the deal committee then acts as a filtering process and say, look, do we think this is an opportunity we would be interested in, or do we think we're at the stage where we could consider it? And they are filtering out some of the companies that come to us. If we then agree to invest, we go through a due diligence process. So at the end of a pitch, we fill in an assessment form to gauge the feeling and the feedback from the team, and how many people are interested in moving forward with it. And generally, those that are particularly interested or have some insight into that business or have some experience in that business, they will tend to lead the due diligence. And again, we're looking, what are we looking at? We're looking at the people, their experience, their capability. We're looking at the marketplace, the potential for scaling up. I mean, to be frank, we're not interested in a little cottage industry. And sometimes people don't understand that. They think, oh, they might have a great idea. But, I'm sorry, it's it could be a sustainable business, but it's not something that could scale up. So that's very important for us. We also are focusing on the Hong Kong and the Greater Bay Area. That's our key geographical area. We're not really looking for businesses in the US or in Europe. We want to be in this region where we have contacts, where we are able to support, we're able to guide these companies. So we feel that's better if it's within a reasonable geography of where we are operating. So I think that's really, probably that's enough for now. I think there's some other points I want to make, perhaps when we come on to the discussion part.
Okay, thanks, Mike. I mean, I do have a couple of follow-up questions just to expand on one or two things you said. So you said that sometimes one of the angels in your group may invest individually, and sometimes you may invest collectively, maybe through a BVI. So
Yes.
I'm curious about the collective investment. Is that sort of a sort of like a syndicated amount where you all put your money in and get an identical share in a BVI? I'm just curious a little bit more about the technicalities of the collective investing.
Okay, so I mean, as I say, there's 35 members in the group. Maybe let's say there's 10 people that have an interest in investing. Those 10 people will may want to invest a different amount of money. So collectively, let's say those 10 people come to $100,000 as an example. It doesn't mean everyone is putting in 10. So if we then put it into an offshore company, the shareholding in that company will be represented by the amount that each individual has put in. Very simple.
Okay.
Really. We're trying to keep it fairly simple.
So very flexible and just an arrangement amongst the angels, and it doesn't directly affect the founder, because the founder is getting the money from the special purpose vehicle, and it affects some. Okay,
And
that's
often
very interesting.
we find that the founders don't necessarily want to expand the shareholding numbers too much. So if there's 10 or 12 of us, but there's one shareholder on their register, which is the offshore company.
Okay, my last question. You talked about your investment criteria, but do you have any preferences for or against certain industries?
No, we prefer successful industries, but apart from that, we're not filtering out any industry that we don't have. We're agnostic from that point of view. We've gone into a whole range of different things. So it's
Okay.
not, we're not focused on one industry. We're really, say, looking at the people and the potential for the business.
Okay, that's super. Appreciate your comments. So just stand by as we are about to turn to Leon, but we'll have you back for the panel discussion after Jonathan is over.
Okay, thank you very
So
much.
Leon, now
Yeah.
now it's your turn, and I'm interested to compare and contrast a venture capital fund to sort of the angel structure that Mike talked about. But I'll let you just speak in your own words.
You know, John, there is not a big contrast between specifically our fund and what Mike talked about, because we are somewhere in the middle between venture fund and angel group. It's we have the platform distributed LPs, and we do not collect fund like other venture capital does. So we do not collect $100 million or $1 billion fund. We get collected, or our LPs participate in investment on the go, I would call. So for example, we have about 250 LPs. We're working together, and each partner has its own chapter where maybe 20, 25 LPs he is working directly, and also other LPs could participate. And actually we co-invest up to $500,000 into the round, where there is either term sheet or company has to have $1 million in revenue. So it's not exactly very early stage companies. So it's maybe So 1 million term sheet or $500,000 term sheet. So lead investor should be in place, or $1 million revenue should be in place. It should be growth of revenue through the year or couple of years. And so we consider many different aspects of investment. But what's interesting, it's a platform. So everybody, every company could participate and could just manage to upload all information about the startup on this platform. And maybe I heard about unicorn pitch that happens over the world. This is what we're doing. So we're doing 3 levels of pitches, of competition. It's a startup contest. First level is unicorn pitch. It could be a local pitch, some country or region, small region, or it could be some specific industry. For example, a couple of months ago, I led African e-commerce and fintech unicorn pitch. It was about 9 companies over the Africa, across the Africa to compete on the first place. And then winner get to the next level called unicorn cup, or unicorn battle, where it's a quite wide area could be presented, and it could be many different, so agnostic to industry. And then the winner get presented in Silicon Valley in so-called unicorn cup. And the winner of unicorn cup, it's just over the world, many companies, winners of battle and pitch, get into contest in Silicon Valley, and the winner get investment from our company as well. So it's 100 get investments. So we have different vehicles how to find the company, how to do due diligence. We do not like to do due diligence by ourselves. Definitely, we have committee of partners which decide whether we have to invest, and then we make a call to all our LPs about this company. We make a presentation of this company. We call to the webinar where a company presents its business. And so it's not exactly a venture fund, but finally it managed startup like venture fund. But the process of investment may be more similar to the group of angel investors.
It's interesting. I mean, I've been in the unicorn pitches for a couple of years now in fintech and healthcare. That's where we first met each other. And when I was listening to how you were describing it, and I almost thought, are we a fintech? In some ways you are, because it's not just the online pitches. You have the whole electronic platform for getting startups, different stage companies. It's a whole electronic ecosystem that, of course, eventually connects with you and your investment colleagues in Palo Alto. But I, for the first time after 2 years listening to you describe it, I thought, are we a fintech as well? And it just jumped to mind. One technical question that comes out of what you said, and I want to dwell on this because it's not often raised, but I think it's an important point. Tell us about the role of a lead investor. Do you always need a lead investor? And generically, for the audience out there, what is the role of the lead investor, and how do they relate to perhaps others in the investment group?
Yes, very interesting question. Thank you. In most of cases, we need lead investor. And at some point where startup just shows very good growth, maybe we don't need lead investor. We don't like it, but some startups so amazing that we are ready to invest even without lead investor, grow to 100% per year or something like this. But lead investor, this is what's important, because lead investor is doing due diligence. Not everyone is going to invest into its own due diligence. It's quite complicated. it takes a lot of time, it takes money. So usually lead investor is a big venture capital fund, who is agreed to invest into this startup about, I don't know, half, or usually it's $1+ million. And then all other venture capital funds and maybe angel investors just join these if on the moment of the term sheet. So if there is a term sheet that lead investor, it means lead investor start due diligence, and we are all interested and waiting for and just sign up to invest into these companies as well. And if, for example, network VC is involved, first of all, you got a huge company, got a huge exposure in Silicon Valley. That's very important. So some part of Silicon Valley invested, and also participate in unicorn pitches, participate in many different events. So it's quite valuable for the startup to get investment from network VC. But again, it's desirable to have a lead investor with a term sheet.
Okay. So
And
it's
usually we
the
invest
lead
in
in-
software. I just want to add that we invest in software. We do not like hardware.
Okay, fair enough. So the lead investor is an important concept, drives the due diligence process, maybe is the largest ticket in that. But I think it's, if someone hypothetically wanted to come to you, they wouldn't have to arrange their own lead investor. They could approach you, and a lead investor might be found out of their engagement with you or discussions. Is that correct?
By myself, I am open to discuss with any startup. I like entrepreneurs. I learn all the time. I learn from entrepreneurs. And I like to talk. And many of our partners like to talk with entrepreneurs as well. So definitely you can come to us. And sometimes we have one company, we were in touch for 2 years. So we just were watching how this company is growing, what happens, and then after 2 years we finally invested into this company. So it doesn't matter, you have to wait when you have lead investor or you have $1 million in revenue and high and very fast grow. No, come today, let's talk. Maybe we can help somehow. I can help. I can make some mentorship just for an hour or something like this. And also I will learn from this startup something new about the business, about development, about thinking. And so.
And we have our next FinTech unicorn pitch in November of this year. So maybe we will be finding a couple new ones for you to talk with.
Amazing.
Thank you.
Usually I'm also a judge on many unicorn pitches. So I would love if you will invite me to this unicorn pitch and I will contribute something.
Guaranteed.
Thank you.
Okay. Now let's move on. This has been really interesting, but I want to give the floor now to Jonathan Nguyen, who is going to provide a model that he developed based on his research of a lot of startups, but I'll let him give you the background and the introduction for that.
Are you seeing a full screen of the deck, or are you seeing my speaker notes?
Can see
I
your
see
full
the deck.
Excellent. Like the title says, we researched over 1,000 pitch decks, and this is what I'm about to give you is what works for a pre-seed pitch deck. Now, a couple of caveats. You have usually a pitch deck that you present, and you have a pitch deck that you send. The one that you send has more information. But if you put too much information onto the page that you present, everyone wants to read the page and not listen to you. And you should be the most convincing voice rather than people trying to focus on reading. Yep. So that's a caveat. Second thing is, you do need a separate document, an information memorandum that has all of the detail, right? So you're going to need lots of numbers, and if you ask John, he could take you through tomes of information that is required. But for our purposes today, I want to take you through what looking at these pitch decks told us. And you don't go into the exercise of searching, finding pitch decks, like over 1,000 pitch decks, downloading them, trying to match them to their funding, and then you don't do that for fun, right? And this whole journey started after I left. So I was at Ogilvy and made their advertising, which is one of the biggest advertising agencies in the world, for over 10 years. A colleague of mine also left, and when I went and joined JP Morgan, he went and joined a startup. And then when I left JP Morgan, and started this company, he said to me, "Hey, we're about to do a round of fundraising. It's our D round. We want to raise $200 million. Can you help us build our pitch deck? Because we've got 2 investment banks working with us, and they've both decided that they're all doing different things, and this deck is a Frankenstein deck." And so when I looked at this deck, I was shocked because both he and I came from advertising agencies where pitching is a blood sport. An internship at Ogilvy starts by you walking in the door and pitching a red brick, and we gave everyone the same red brick, and they had to pitch why we should buy this red brick. So I turned my attention to what pre-seed decks, all startup pitch decks look like, and the main thing that is the problem across all of them is they don't understand story. So the good ones do it, and I'm gonna take you through a good one. But if you don't understand the story, it's going to be very hard to convince an investor. And why is that? So VCs don't have a lot of time. If you look at the data, and if any of you guys use Dropbox DocuSend to send your decks, then they don't pay me, I pay them. But they publish data every year about how much time people spend reading the decks that are sent through DocuSend. And as of 2022, a VC will spend 2 minutes and 42 seconds to review a pitch deck on average. Now, if that deck is ultimately unsuccessful, and you look at the data, they spend about 2 minutes and 13 seconds, right? That's not a long time. And if you do well, they give you another 23 minutes. Now, why is that? It's not because they're mean. It's not because they're trying to be arseholes. They just don't have time, and they have different priorities. If you look at your inbox, your Slack, you know how many different communications come into your inbox. Now imagine on top of that, an established reputable VC will get upwards of 150 pitch decks a week. So your pitch deck is in there, in his inbox, and hopefully getting a fraction of his brain space or her brain space when they're also thinking about their anniversary, their children's birthdays, the state of their other startups. So you have so little time. So what you have to do is you have to use a secret weapon. And that secret weapon is, for most VCs, they experience a huge amount of FOMO, or fear of missing out. You don't want to be the VC, and this is a friend of mine in Silicon Valley said to me, I don't want to be the guy that has Mark Zuckerberg's original pitch in my inbox as an unread message. So as much as they're happy to like fob off vendors and job applicants, there is a real cost, an opportunity cost, if they miss out on a pitch. So what you have to do is you have to hack their brains. And for me, the approach is very much like writing an ad. It's getting their attention, telling them a story that they're in a structure they expect. Don't let them have questions lingering in their minds, and then make it really easy to understand. Because a huge, huge problem for startups is they're founded by product people, very smart people, who know the product deeply, but aren't very good at making things easy to understand. So I'm going to take you through a very strong pitch deck. This deck raised 2.5 million at pre-seed for a company called Method. And first thing you do not waste your front cover. Use your front cover to start with a very crisp positioning or purpose, so that when I look at this, I'm intrigued and I understand. I have a sense of what an embedded debt repayment API is going to be. And that's 4 words on that page. The next thing is, now that you've got their attention, you've got to give them the problem, and the problem has to be really easy to comprehend. When I read 99% of Americans make debt repayments using archaic methods, I totally get it. And the use of the word archaic makes me feel the burden of this debt repayment system. The next thing you got to do is spell out the situation in the simplest terms possible and have the visuals support your message. And what I really love about this is, while they're spelling out the current situation, they take a stab at the incumbents, and they do a very clever positioning thing here, and they reposition the incumbents as costly and unsecure, okay, in describing the situation. Notice there's no jargon here. Then you've got to give the aha moment. State very clearly your insight or unique perspective. And again, use very few words. So Method gives you the aha moment by saying it's a holistic financial management is taking off, and debt repayment rails do not exist. So whereas bank transfers and payment rails exist, debt repayment rails do not exist. So very simple, not difficult to comprehend. And then when they spell out their solution, they do something that I really like, which is to show, don't tell, is to show a journey that is very simple and straightforward, again, without jargon. They outline what their solutions are, again, in very simple terms, what products they're able to deliver. And then they start to wrap up by describing the size of the market. Now, this is what I would call a napkin calculation. So at 65 cents per transaction, and there are $10 billion per year, they're calculating that the opportunity is 6.5 billion, right? Now, this is not going to work at every stage for every company, but at an early stage startup and as a Y Combinator grad, they're able to get away with this type of calculation. Your mileage may vary, so you've got to understand who you're pitching to and what your capabilities are to sell the idea. Next, you've got to ask for something, and your ask, again, state clearly how much you need and what you're going to use the money for. You do not, in the pitch deck, need to go into details. This will come later. You will be asked for this in due diligence. But give the investor a very clear, simple to understand breakdown of where you intend to invest. By looking at most of these charts, an experienced investor will already understand whether you're being realistic or whether you're completely off the charts. Finally, you can do it here or you can do it up front. Talk about your team. any experience they may have. These two guys, young guys, not a lot of experience, but they did graduate from Y Combinator, so they've got that in there. They talk about any previous experience they have and educational experience. Finally, on your closing slide, you just have to remember to put your contact details in there, because good decks get printed out and passed around. And you may think that you included your details in the email, but that email doesn't come attached to the deck sometimes. So you might lose opportunities because someone's printed out this deck and can't find how to contact you. So on that note, I leave you with a leave behind slide. I'm not expecting you to read this. If you download this slide, you'll be able to see what's on here. But every stage, every industry might have slightly different requirements, and you've got to research who you're pitching to and make sure that you cover the things that they're going to be looking for. But most important of all is have your story locked down. So that is my presentation. I leave you with the obligatory Q&A slide, and if you'd like a copy of the deck, feel free to scan the QR code and you shall receive it in your inbox. And on that note, I throw it over to you, John.
Well, this is really going to be a discussion that I want to throw to Leanne and Mike, but I'm going to make one comment. You know, when I did my first 24 years in investment banking, it was all about large deals, $1 billion euro bonds, large public things. And they were companies, governments with a long history of financial records, and there was a lot of financial analytics. But when you're dealing with early stage companies, some that are maybe pre-revenue, there's maybe no financial analysis, or at least historical financial analysis to do. And so I had to change my mindset when I moved into this sector. And it's really, Leon and Mike both emphasized people, and you've added a second variable to that. It's the people and the story. And it's much more descriptive. It's the powerful message. It's the story. You know, the first time I saw this slide deck from you, I thought, wow, so little text on each slide. You know, whereas some of the pitch decks I see, they almost look like, you know, a 1,000-cell Excel spreadsheet. There's so much content on it. But if you look at this pitch deck, it's just sort of a few powerful messages on each page in a slightly larger font. It's very, very different. So it's I learned a lot when you walked me through this pitch deck. But enough said from me. Let's turn it over to the experts, and I'll just leave the floor open for Leon and Mike to make any comments, add any other thoughts they may have about early stage presentations, maybe even pre-revenue. And that's what Jonathan was focusing on here.
Maybe can I start, just ask Jonathan a question? I mean, first of all, excellent, absolutely excellent.
Wait, did he say excellent? Absolutely excellent?
But would you agree that sometimes, rather than having one pitch deck, you may have 2, 3, 4, depending who you'll be talking to? So your core pitch deck is there, but you slightly adjust it.
Exactly. So you might have we ended up with something like a 78-page deck for my friend's biotech startup, for instance. But depending on who they speak to, they have to cut that down and massage it. And then the deck that they send is different from the deck they present. So you in the talking to the same group of people, you might be giving them 2 or 3 different decks depending on which groups. So at a D round, for instance, they were presenting to the Bill and Melinda Gates Foundation. They were, pitching to African CDC, and so all these parties, and they all had different requirements. So it's really, really important to tailor the deck to the audience.
I have very interesting. Maybe I open some secret how investor is thinking. And maybe it's also a secret for investor itself, how he's thinking. What I learned, and I'm in a board of European Consciousness University, and we put some efforts to learn how subconscious mind really works. What I can tell you, investor ask you, please elaborate on something, and at that moment, his subconscious mind rejected this speech already. Even he doesn't understand by himself about this, but his subconscious mind rejected. And what happens next? Entrepreneur get into details. And investors start to reject these details. In 5 minutes, there is a scandal, and they just talk to each other in a high voice. And this happens always. So entrepreneur should learn psychology by himself, because investor has 1,000 entrepreneurs. He doesn't have time to think subconsciously. He's thinking or take subconscious thinking to the conscious thinking. So what I suggest, and this is what was written by Wolf of the Wall Street. He developed so-called streamline sales pitch theory. It's interesting. Instead of getting into detail, if investor asks such a question, please elaborate, get from the beginning and get the same pitch again, maybe with some difference, because you already understand where you have some problem, but get from the beginning again. So this is very important. Never get into details with investor, because at this point, investor already decided not to invest, and all his body and mind will be in a resistance mode. This is the first. Second, you should wait, or you should get from investor the following phrase: please tell me more. And this is where you can get into details and elaborate, because in this case, investor's subconscious mind decide that this is good, this is interesting, and I would like to learn more. And this is your chance, like entrepreneur, to get into details and convince investor about your business.
It's very interesting. I mean, you mentioned the word psychology. Obviously, you elaborated on it, but I took a minor in psychology in undergraduate, and I think that everything that happens in the world, business, investing, politics, people talking on the train, they're all human interactions, and understanding human psychology is so important. And I think where that sort of connects with Jonathan's structure is that when we're talking with early stage investors, we're talking about powerful ideas and detailing where the other people come from. If you can do if you know you're going to give a presentation to 2 people at VC firm A, maybe you find their profiles on LinkedIn and you can do a little bit of background and do a little bit of research, because the more that you can communicate with them in the right way, the better off you will be. So yeah, thank you for that. And yeah, psychology is really, really important. But of course, that is at the heart of advertising, isn't it, Jonathan? Psychology.
It is indeed. So all value is perceived value, and all decisions are made emotionally and post-rationalized afterwards. So you've got to get the story coherent, cohesive, get them to like you, and then they will find reasons, rational reasons to invest. And then obviously that goes both ways, right? Sometimes it can go wrong. So that's why you have the due diligence process later. But when investors at investment banks talk about market color, market sentiment, they're not talking about they're talking about mood, right? So these are the things that we always have to remember. As soon as you go into details, people switch off or they find reasons to argue with. But emotions is hard to argue with.
Okay.
Can I just add to, Jonathan, you said, get them to like you. I mean, our business is a sales business, and when we say people buy from people, so they've got to like you. I'm surprised how many people have done pitches to us and they come in with an arrogance that almost straight away we don't like them.
Yes.
Almost before they've flipped the first page, their body language and their arrogance has turned us off, and our mind is closed to that already. So it's quite interesting. Can I raise another point or open up a little bit? Again, a very early stage, when people are pitching to us, I've been really amazed how often people come with not having a valuation to put to us. And, it's not on the slide deck, or if we ask them, well, people say, well, we haven't thought about that yet, or we're still considering it. And I answer them, or I go back to them and say, well, if you were selling your car and I come to look at it and I say, how much do you want? And you say, you don't know. It seems a bit silly. And that happens so often. Okay, it's a number, but it's a starting point. But to not have a number, to not have a view on what valuation you're putting to this panel in front of you is very, very remiss, put it that way.
Mike, I want to expand on that because it's an extremely important point. Now, when I was doing valuations on listed companies and things like that, it was very easy to do. At least no one disagreed about the methodology. They disagreed about the final number, sometimes by a lot. But when you're talking about early stage companies, which maybe are pre-revenue, what sort of methodology or what sort of approach can they take to give you a number?
What, John, your question was, how do we arrive at a value, is it?
Or how does the founder who's maybe pre-revenue, how do they go about getting a value for their company at that early stage?
Well, there are some websites out there where you can put in various factors, even though you haven't got revenue. You can put in factors about the market potential, where you are, and a lot of things. I'm not sure how realistic they are. I think at that very early stages is very much gut. I mean, as you say, you haven't got revenue or margins to work on. So again, we're looking really at things like, how much confidence do we have in the people? What is the business potential? What is the scalability? And areas like that. Of course, there's a negotiation at the end. And I think sometimes we get absolutely outrageous valuations, and that is a turn off straight away. Your mind just switches off straight away. And I think from a founder's point of view, they've got to find a value or put forward a value that seems fair. They've got to understand that the investors are taking a huge risk here, and also therefore want a return. And they also, from the company's point of view, it's very important that if there's a series of rounds, that those rounds are going up. It's a very negative if a round is too high, even if they get the money in, and then the next round is flat or even lower. That really puts a dampener on it. And I'm helping a company at the minute, and I actually encourage them to lower the valuation for this round, because the next round is going to be a much bigger round, and it should be a step up in valuation. But it's a bit of black magic, really.
Well, I mean, this is a really interesting but very important question. Leon, what are your thoughts? How does a really early stage company come to a valuation? What is there a methodology that you recommend?
Actually, yes, but most of the investors consider this like a black box, So $1 million valuation, I put 100,000 for 10% of the company. This is I hear from 80% of early investors all the time, because it's very difficult to evaluate. It takes thinking. Usually, for me, for example, if I think about something, I usually miss the point because we cannot, like human being, we cannot think about all these parameters at the same time, and usually our decision is wrong most of the time. So some people just leave it for their very rigid valuation, 1 million for 100,000. But sometimes, if company is very much interested, and investor founder has 2 exits, and invested his own money and came to me with something that is ready, and invested, I don't know, $50,000, $100,000 to build this product, I expect that this founder could name the value, okay? Because he invested already, he did exit, he understands the business, he's an entrepreneur, and he knows his business much better than me. So come to me and say number. This is important. So again, this depends on history, on track record of the founder, depends on potential of the company, depends on the market. For example, today all investments are down, expect AI. So today is a huge competition in AI, and valuation is very high. And always there are some outliers where you have the line of investors because something happens within this black box. So again, there is a rigid approach, 1 million, 100,000 for 10%, and there is some very flexible approach dependent on potential of the company, potential of founders. And again, all come down to negotiations.
But you did mention another slightly different point, but I sense it's very important. And you said, how much have the founders put in of their own money?
Yes.
I suspect that if it's sort of like an old banker's expression that you want to see the people you're lending to or investing in, that they've got skin in the game and they're not just 100% playing with everyone else's money.
Yes, exactly.
Okay.
But again,
Well,
it's for founder who has exit already, had exit, because some people have skin on the game working 24/7 on the project. It's the same skin of the game. And it's even more valuable than money, their time. So again, it depends.
My last question to you and Mike, in addition to just percentage of shares for the money, do you demand anything else like appointing one director, or are there other things other than just the number of shares that need to be considered in this first round negotiation?
If I go first, I mean, as I say, as an angel investor, we're not putting in huge money, so we're not normally in a position to sort of demand too much in terms of that sort of control. I'd say it works the other way. Very often they're looking for us to come on as mentors, and that can lead to effectively becoming part of the management team. So we're not in a powerful position from that point of view, I think, to demand too much. Can I just go back a little bit? One thing I always like to ask and check is, are the founders drawing a salary? And if they are, what sort of salary? Because again, we don't want to be in a position where putting our money in and people think, great, this is great. Now I can take a nice salary out of the company before it's even, got up on its feet.
Yes, there's an old joke, and I'm not going to mention what jurisdiction it came from, but you always knew who was successful in raising funds because they are the ones who just bought the new BMWs.
Yeah. Yeah.
Okay, that's really great. We've sort of run over, but it was really interesting. I think this whole discussion about Jonathan's model, about how you need to approach investors with the feedback from Leon and Mike, and of course, the background of how their firms work and deal with founders, I think is very, very valuable. And all three of these gentlemen work as mentors on the AZN FinTech. And for any of you who care to join us in the program, which I think closes for registration on the 20th of August, so just less than 2 weeks from now, and then we kick off on the 4th of September. So we hope to see a few more of you on board. And thank you for your time, and thank you for Jonathan, Warren, Leon. I was going to say Warren the second, Mike, sorry, for your attendance. That was really, really informative. I got a lot out of that.
Are you still here? Why don't you hit the like button? I'll wait. While you're at it, hit the subscribe button. It's bigger.